Okay, everybody, we've got a great show today with the famous Katie Stockton. We're going to be talking charts, talking trends. My name is Dan Weisskopf. I'm the ETF professor, also lead ETF strategist for the ETF think tank. We're going to be letting some folks in over the next 10, 15 seconds, and then we'll launch right in and talk markets, the Fed, and all the things that we know are going to be happening. Thanks, Katie, for being patient while we let the folks in.
I'll kick it off next. David Chikansky here, fellow portfolio manager within the Title Financial Group. Very excited to have Katie on today on Fed Day. I know this is a day a lot of people had circled on their calendars, and Katie's as good as it gets in giving us some updates on what we can potentially expect. And as I like to kid, tell us what her crystal ball says in the coming months ahead. Katie is the founder and managing partner of Fairlead Strategies. Katie, if you could introduce yourself and anything that's top of mind to kick us off today.
Yeah, for sure, David. Thanks both of you for having me today. It's funny. I feel like it's a day that the macro strategists are in very high demand, and yet the technical strategists usually get to sit back and just relax and react to the market action, right? But no, glad to join you. As mentioned, David, I started Fairlead Strategies, and it's I'd say probably best described as an independent research provider, and now also a ETF portfolio manager. And I started the firm in 2018. I'm a CMT, or a chartered market technician. So my real sole discipline is technical analysis. It's all I do. And I love it. I have a methodology that I've developed over the course of my 25 plus year career, sort of vied along that career path pretty much the whole time. Had some great mentors who helped me shape my methodology. And I have a great team now at Fairlead Strategies who helps me produce a whole lot of research, do a whole lot of consulting, and manage an ETF.
Awesome. So let's speak first a little bit about the ETF so that everybody can understand what the ETF does and how that also is managed versus perhaps your decision making and your thought process on global macro trends.
Of course, yeah. So the ETF, it's called the Fairlead Tactical Sector ETF, or TACK is the ticker. And it is based on my methodology. We essentially created a rules-based system from our indicators, which we categorize three ways: as trend following or momentum, overbought, oversold, and relative strength based, all of which we hold, a lot of importance around in our work, in our research, in our just thoughts. The ETF is very long-term in focus. So that is one thing that might differentiate it from parts of our research. Our research does tend to focus mostly intermediate term, but always with an eye towards the long term, because that really shapes our bias. And then also an eye towards the short term, because that helps us manage risk on behalf of our customers. So we have multiple time frames that we're considering. The ETF is using monthly data. So it's month-end closing data with a monthly rebalance. And we're starting with a universe of 11 sector ETFs, so specifically the sector spider ETFs, along with 3 what we're considering to be risk-off asset classes represented also by ETFs. And that's the short-term treasuries, long-term treasuries, and gold. So we have those 3 options to basically fill a bucket when we don't have enough sectors qualifying for our models. So we're starting with an equal weighted sort of set of 8 buckets to fill. Right now, all 8 buckets are filled with sector spider ETFs. So we have a fully risk-on environment for the TACK ETF right now to take advantage of. And that happens when you have a couple of things working for the market, when it has strong positive momentum, but also strong breadth, meaning participation on the sector front is broad. That's when you get 8 or more. sectors qualified. And so we had that for just really kicked in at the end of last year, that the breadth expansion was very meaningful. Most of last year we spent in just the leading sectors of the market, which were highly concentrated in these mega cap heavy sector spiders. So technology, communication services, consumer discretionary, of which we still have those positions. But now we also have broadened out, of course, into all these other sectors that have finally seen these long-term momentum gauges turn, have captured enough relative strength, and lack the kind of sell signals that lead us to manage risk from a long-term perspective. So the goal of the fund is to obviously leverage sector rotation, sector relative strength and momentum, but then also when the market's not firing on all cylinders, which of course has been the case quite a bit actually since we launched it in early 22, we have the ability to move somewhat risk off through those alternative asset classes. And that helped us a lot to limit the drawdown in 2022 and at different points in 2023 during corrective phases. So we're aiming to limit the drawdowns as a way to really foster a core U.S. equity portfolio that folks don't have to worry about, almost like an alternative to the old buy and hold. You can actually buy it and hold it, but it's working dynamically for you. And as you all know, from your seat, it does create a nice tax wrapper around a sector rotation strategy, which is somewhat high frequency. The turnover of the ETF ends up over the course of the model. We evaluated it to be about 100% annual sort of turnover. So it's high frequency enough that you see a lot of shifts underway on the sector front that we're trying to leverage.
So when you're introducing, I guess we'll call it defensive assets into the portfolio, it's initially a lack of opportunity in the offensive side. And then I assume some sort of screen on the defensive side to choose which defensive asset you're looking at. So it sounds like you did miss a lot of the bond drawdown in those long-term treasury positions last year. Is that fair to say?
Yeah, what helps with that is that we've diversified the risk off component of our ETF, meaning that we have not just long-term treasuries as an example, which of course would have been somewhat painful, especially in 2022, but we also have the short-term treasury, which is not a cash equivalent, but something closer to it. And then that gold component, so it's via GLDM, which is the gold mini shares. So we have that diversification on the risk-off categories that has helped us not get the concentration risk associated with the singular asset class. And as you know, over history, these asset classes tend to do better than the equity market in big bear market cycles. And that's really what we're trying to avoid. We're not too worried about missing every corrective phase. We'd love to, see less downside than the market, but where we want to go almost fully risk off, if not fully, is when we have sort of a 2008-9 type of event. We had over the course of our back test, there were only 3 times during which we went to that fully risk-off stance. So it's almost, the old 60-40, right, is how it almost sort of lays out over history, but it's very dynamic, right? At times it's 100% full equity exposure like it is now, and then at other times it'll be fully risk-off.
So right now, is it fair to say that you're at your peak offense, or could you get even more aggressive if you had more technology? And is it usually equally, or can you reallocate your weightings?
It is a peak offense based on the model. We, of course, have the ability to change that, but we hope not to change the model. I really want to keep it very systematic, 100% systematic if we can, and an environment would have to be really unusual for me to overrule that. And in fact, it's been doing exactly what we would hope it to do in response to the market dynamics. So it started out with nearly a full sector position at 7 sector ETFs, and then it's gone now to the full position. So that was like right at the very beginning of the bear market cycle. It was coming in, with a full or nearly full sector exposure. But now is the first time that it actually has 100% equities. Now, the disadvantage can be that the technology sector is equal weighted, right? We know that the tech sector is such a massive component of the S&P 500. So my advice has been that TACK creates like a great core holding. And then in a strong tape, you want to supplement it with technology stocks because first of all, most people are most interested in buying technology stocks. It's just reality based on at least the questions that I get in my research and consulting business. So I feel like they can have TACK as something they don't worry about, but gives them that core exposure and then supplement it with technology stocks.
So I would follow with like maybe a bit of an oddball question. I'm fascinated that the energy sector in the S&P is so small, right? It's 3 it's basically irrelevant, but it's such a key component to the overall GDP. At least in my mind, it is. That's part of your sector allocation potentially, right? But if you get overweight energy, if you allocate to energy, you might be extremely overweight the S&P.
Right. And that's, very much intentional because we're trying to reward even the smallest sectors, energy materials, with that overweight position because we want to leverage their relative strength when they have it and their momentum when they have it. Energy is not one that's included at this time because it has seen a significant loss of long-term upside momentum, even though short-term we are looking for a little outperformance there. So sometimes our short-term biases will be misaligned with what's, looks like longer term. But even still with the energy sector, I mean, you're getting a pretty massive overweight and yet it's such a broad sector. There's a lot of stocks in that sector. And, so you are getting some cap weighting, of course, just by the nature of the sector spiders themselves being cap weighted. So you are, I'd say, essentially rewarding the stocks that have been rewarded by the market with their market cap being, heaviest or highest. So we have a little bit of a cap weighting on the individual stock level through the ETFs that we purchase. And we're well aware of that because we don't have a fundamental component to it. And we're just trusting that the market has rewarded the right companies with that market cap. But we are excited to be something different than the S&P 500, right? We don't want to look just like the S&P. We want to be able to add value by identifying the strong leading sectors. And in all cases, except where it's all about technology all the time, where you have leadership from other sectors, that should be a benefit to the portfolio.
What's new in the technician space that's notable in the last couple of years? I feel like the entire macro world just flipped all their formulas upside down last year and started from scratch. Most notably discussing like the Fed's balance sheets and how to calculate what is actually QT and what is QE. What's new in the CMT world over the last couple of years that's like gaining some recognition and has some merit?
There's a lot, right? I'm sort of an old dog, so I'm using my old tricks still. The beauty of technical analysis is it really is math, right? The indicators that we're using are completely unbiased. They take out emotion. They give you a binary response at times, a buy signal or a sell signal, or is this positive momentum or negative momentum? And because we just have one data point typically that we're using from the market being price data on which we're basing everything, we really don't need to innovate all that much to keep things moving forward because we're talking about tools that we even use the cloud model as an example. It's called Ichimoku, and it's a Japanese model that was apparently developed around the rice trade back in the 1800s. We've got some really, really historically sort of established indicators and tools that we're using. The MACD indicator has been around for decades and decades. So I think that, the old sort of tried and true indicators will stay that way, and that the innovation actually comes more not in the indicators themselves, but in how people are combining them and leveraging them, right? They're leveraging them through technology. They're leveraging them through different ways of managing risk and through different products, right? There's so many different types of products, and it's almost less of a technical analysis development and more of like a portfolio management and risk management and market structure development that we're, sort of enjoying on our end. So for my process, I really haven't added much new. I'm always looking at new indicators that I hear about, but it really would take a lot, I think, for one of them to work their way into my process. We believe that, all the information, supply and demand, is boiled down to that price action, right? So that's what we care most about. And you can, be very simplistic in how you approach the charts by just using a moving average or something of that nature. We tend to get a little bit more complex with it, but we still don't want to get terribly complex where we have multiple indicators that are judging the same thing, right? Because that could be putting us at risk for confirmation bias. So we try to make sure that we have a couple indicators for each of those categories that I mentioned before. And then we, of course, always have an eye towards important levels on the chart. So support levels, resistance levels, because that's where we get the sense of risk reward. And I think that's where the real value can be for especially folks that really adhere to other disciplines, for them to have a sense of the risk reward profile of any given name. And I think just adds a lot of value. So sort of an old dog, but there is a lot new. It just doesn't happen to be around indicators per se.
Do you think that ETFs validated and make technical analysis that much more important today? Because it becomes self-fulfilling to a large degree, right? That people can use technical analysis.
Yeah. I mean, so because I see technical analysis and indicators work on things that are completely obscure at times, right? That you have to know that there's more to it than just a self-fulfilling property. Indeed, there is that at times, like when you see a 200-day moving average, act precisely as support or resistance. Well, then it's probably because there's a whole lot of eyes on that 200-day moving average, eyes probably also including algorithms, right? So there is a self-fulfilling component, I think, to certain setups and levels and indicators. But because we have, ways to apply the indicators to things that you would think that are probably not on a lot of folks' radars and it still adds value, that gives me the peace of mind that there is more to it. It really is just math. It's really a reflection of the supply and demand for that security. And that's what we're trying to measure. So we're trying to measure prevailing trends, the momentum behind them. We try to gauge whether there's exhaustive signals, and we do that through those overbought, oversold metrics, because at the end of the day, that's what we all want to know is if we know the trend, right? When is it going to end, right? When is the S&P going to stop going up so fast?
But this has been a much more muted year for equal weight than the S&P 500, right? I mean, we've seen drawdowns in both equities and fixed income over the last couple of years, and we've seen spikes in fixed income volatility, but equity volatility still is very muted. Do you have any insights on the VIX? Because it does feel like a lot of technicians are saying the VIX is starting to act a little bit funky, where you'll have up days in the markets where the VIX is actually slightly higher, which is, from a technician's perspective, sometimes a little bit wonky. If you have any insights on VIX, I know there's a lot of people who are looking for that to be a hedge to their portfolio that didn't really work in 2022. And is it the unforgotten hedge in 2024?
I mean, I personally stay away from VIX-related products because they do sometimes act in a way that I feel like is unpredictable and doesn't make a whole lot of sense. So I'm not a big, proponent of those products. However, I do use the VIX. I do use the VIX as a transactional gauge of market sentiment, and I use it in conjunction with other sentiment gauges. You'll notice in our conversation, I'm always diversifying the way I look at things and the way I invest because I like how it gives me that sort of risk management element. It gives me a broader picture. And the VIX is just one sentiment indicator for me. I also use the fear and greed, which actually has the VIX as one of its components. and then the investor polls. And it's when all of those taken together show an extreme reading that I really pay attention. And indeed, we have had readings that have shown that, sentiment is overly bullish of late. And that's something we've got our eye on, of course. The VIX has had, I think of the VIX not as a really strongly trending instrument, but rather something that has cycles, right? You have low volatility and high volatility cycles. And right now we're in a low volatility cycle, and we want to respect that as overall being sort of a market bullish factor. And then we'll evaluate the short-term swings and try to understand, well, how does this influence or reflect market behavior and risk appetite? And we get excited when we see VIX spikes because, as you know, that those tend to be associated with market lows if you can time it right. So we definitely pay attention. I don't scrutinize the day-to-day action terribly much, but we like to know what kind of cycle we're in, and we like to identify potential, sort of events through the VIX that are emotionally charged.
So when I'm looking at the Bitcoin spot ETFs, you knew this was going to come up. I can't resist this, right? You've got massive transparency into flows coming into the space. You've got, 10, 15-year chart on Bitcoin, depending on how you want to look at it, is my point, really. What is your thinking around all that's happening in the way of Bitcoin? And I think it's fair to say, express it in two stages, if you would. If it goes to a new high again, what does that mean for the future in terms of where you might set a target?
Well, there's nothing bearish about new highs. I always like to say it's like people seem to be so skeptical when something reaches a new high, but it is often something that presents a positive long-term catalyst, right? You sometimes we'll see a pullback like we have in Bitcoin on the back of a breakout to new all-time highs, sort of natural, especially after such a massive up move. And yet the new highs relieve the chart of resistance, right? So where there once were sellers, those sellers weren't there anymore, or they weren't strong enough to hold it back. So that release is usually a long-term positive. The hard part is to, understand what the upside is from there. So we tend to use something called a measured move projection, and it's really very simple. It's assuming that the trajectory of the current trend will extend itself or continue. So sometimes we have to go back to essentially an important low on the chart and an important peak and trough on the chart to reference these measured move projections or to project them. And for Bitcoin, it arrives at an objective of about 81,000, which arguably sounds like pretty conservative. And yet that's just what the chart lends itself to right now, because it's treating the bear market cycle in cryptocurrencies as almost like a corrective phase, right? Like a massive stair step, up, down, up. And so it's using that as the point of reference for the measured move. So it gets to about 81,000. We're comfortable with that as a several month objective, if not sooner. Things always seem to happen quicker in cryptocurrencies. And I think the important thing to do with crypto is to treat it in an unemotional way, right? To make sure that you have the technical indicators on your side, to acknowledge the volatility, right? To know that, just know what you're willing to lose and make sure that you're protected somehow. And that means different things for different people. So we, in 2019, started to publish a weekly report on cryptocurrencies because we felt like there was almost like the need in the marketplace for consistent, professional, and unbiased analysis that could help traders, right, navigate the big swings. So we do spend a lot of time with it. It's not the bulk of what we focus on by any stretch, but we do feel like we're sort of providing a service in that consistent technical coverage of Bitcoin and Ether and some relative work on the altcoins. We are excited to see more institutional adoption because as that happens, the trends probably normalize a little bit. They get a little bit, more, I guess, or easier to navigate would be probably my guess. These parabolic moves are really difficult to navigate. And yet, we'll just take it as it comes and use the tools that we know, lend themselves well to these kind of highly volatile instruments.
We are recording this on panelist mode, but I wish the crowd could have seen the grin on the ETF professor's face as you were stating those expectations. I don't think I've seen him smile as wide in quite some time. So we have a very happy, ETF professor here. So obviously, most of the sector stuff you're doing is focusing on the large cap stuff. We've seen significant concentration returns in the large cap with now the Magnificent Four. We've also seen significant concentration in small caps, right? Two names have really pushed the majority of the Russell 2000 returns so far this year, one of which is on its way out. So as a technician, how do you look at some of these really broad indexes from a technical perspective that are being driven by 10 basis points of their holdings? Oh, and by the way, one of those is now on its way out, right?
Yeah.
So yeah, how do you think about that from a technician's perspective?
We do think about it, and we just have to have the awareness, right? There's nothing we can really do about it, unfortunately. We can't control how the indices are structured, but we have to make sure that we have an awareness of what the mega cap components are, taking up in terms of the weighting. And that, of course, affects the smaller benchmarks as well, like the Russell 2000. So to know the components, so we just pick them apart as we research them. And we kind of make sure that the breadth is there. So the breadth data is really key to making sure that these trends are real, so to speak. So as an example, you can look at the S&P 500 AD line, or advanced decline line, and you can see that the AD line is at new all-time highs alongside price, right? So that tells you that, listen, even if it's not energy making a huge contribution, right, in terms of their cap weighting, at least there's good participation on the individual stock level. And that can be key because that helps, I guess, bring up the slack when some of the leading sectors or leading stocks start to pull back. It's, that rotation is what creates a very strong tape. So I'd say we reconcile the major indices and their posture alongside the breadth data to make sure the cumulative measures look the same and are supportive of the trends that we're seeing. But it's all very traditional what we're doing, with the Russell 2000 index. We're applying the same indicators irrespective of the components, because at the end of the day, we have, our clients are interested in IWM for one. They're actually trading this, whether they know what they're exactly, trafficking in on the individual stock level or not. The IWM and, these other sort of index-related ETFs are really very popular. So we treat them really as ETFs too. We have a new report that we released not too long ago where we take all these very actively traded ETFs. So I'd say probably 60 or so in total. And we're publishing on them sort of just with this apples to apples comparison, looking at all the charts next to each other for different asset classes, international commodities, FX, fixed income, and then, of course, equities on all the way down to the group level ETFs. And I think that's a great exercise, is to, especially in keeping yourself honest with your positioning, where if you consistently or systematically revisit the charts and the setups for the ETFs that you're trading, right, in your portfolio, I think that kind of chart book or flip book will help you identify breakdowns. It'll help you identify spots of relative underperformance and really just keep you honest in terms of what's really happening, from a supply and demand perspective. You can see that a lot of the fixed income ETFs, of course, have a very positive correlation, right? So we have just the macro force there driving these ETFs, but you can also see collectively, when you look at them all together, you'll see certain things that are developing in a few and not the others. And that can give you a nice, foreshadowing of what may be to come for the others. So I think it's a great exercise to simply scroll through a lot of charts with whatever preferred indicators you'd have and compare all of these ETFs And then, of course, still acknowledge that the components might be heavy, in one stock or, one part of the market, and just acknowledge that.
So when you're, as an example, looking at investing through your fund or otherwise, in XLK, I'll just throw it out there. You're looking at the underlying on how Microsoft is also performing. And in looking at the underlying, you've got greater confidence that your research is going to lead to outperformance on the ETF. I'm getting it right?
Yeah, so we also do bottom-up work. I think you're getting at that to support the top-down inputs. We give more weight to the top-down inputs because we believe that the top-down inputs are essential to succeeding in the markets, right? We all know that when the market's going down, it hardly will leave any stock unturned by that weakness. So we want to respect the price action in the major indices, and of course reconcile it with the breadth data to try to have a good understanding of what the top-down influences are. And we also do that, as mentioned, over different time horizons. So we start long-term, looking at the monthly bar chart, and that sets the tone. And then we go to the weekly bar chart and we get a sense of what this, maybe the next 3 to 4 months looks like trend-wise. And then we go down to the daily bar chart and we'll try to see, do we have support nearby? Is there an oversold upturn that creates like a trigger to add exposure, that type of thing? So we use the multiple time frames as well. But then on top of all of that, that's essential to the process. We will also scroll through a whole lot of individual stock charts. So in our long-short recommendations in our weekly report, we're evaluating the entire S&P 500 for those ideas and trying to find not necessarily like the top 5 names or something like this, but names that we find compelling from a bottom-up perspective, but they have to be in fitting with what we're seeing top down as well. So when we're a little bit more cautious, you might see us lean a little bit short in our ideas, and they're usually easier to find when we are cautious, and vice versa. And we also try to concentrate in sectors that we feel like are winning sectors. We are always on the lookout for catalysts. So we want to see breakouts, breakdowns, MACD buy signals, MACD sell signals, stochastic upturns and downturns. Just like a fundamental catalyst that creates an impetus for us to want to add exposure. The biggest and best part of a move is often in its early stages. So we feel that the catalysts that we see sort of generate that demand surge that we want to be there to take advantage of. So we're in a way, momentum followers, but also some of those opportunities are of the oversold nature.
Yeah, you probably can't speak individual names, but if there are themes that you have like a positive fundamental bottom-up thesis on, I can throw out a few to start, just like, for example, some of the international marketplaces that are competing with Amazon are doing pretty well as of late. Those Ozempic trades seem to be all the rave. Apparently, they're going to help us do everything, including making us less susceptible to social media, which time will tell. But yeah, if you could talk maybe some thematic trends that you're seeing on the individual stock level, if not individual stocks, that'd be super helpful.
Yeah, no, for sure. And I am at liberty to talk about individual names. What I notice is that last year it was all about yields, right? So the day-to-day action in yields really impacted equities. Now it's NVIDIA, right? So to bring up the obvious one. So NVIDIA has, just such strong momentum. It's reminiscent of the early stages of last year. And I think it's the sort of number one influence on market sentiment right now. We can broaden that out to include semiconductor stocks, and semiconductors tend to be market leadership in strong tapes, right? So we've seen semis do very, very well in relative terms. Just recently, they've lost some momentum. So we're seeing a pullback or consolidation develop in semis that I think the market will welcome, if not already. So semis has been a real theme, but we moved recently more equal weight tech, short to intermediate term, because we have that downtick and we feel like it got overdone. So we're more constructive in the near term on some of the, I call it relatively oversold segments of the market. And by that, I mean the actual ratio of the sectors or the sector spiders or whatever you're using as the benchmark versus the S&P 500 are at the place where they're coming off of an oversold low. And that's an intriguing setup to us right now in this environment. So that would include something like financials, right? Financials have an oversold reaction underway in relative terms. That's somewhat intriguing to us. So we like that type of setup where we can take advantage of that. We've even seen the defensive areas of the market do a little bit better. So because of that, and because they've been so beaten up, we've been sourcing even utilities and consumer staples for some of our new ideas of late. We have noticed in terms of positive technical catalysts, a big breakout in copper. Copper has been a theme of ours over the last week or two, and it's simply because we see the price action lifting copper itself and big names like Freeport, McMoran, and ETFs like COPX above key resistance levels. And it's a pretty high probability long-term setup. It's like a long-term triangle formation has been resolved to the upside. And if you think about copper, well, it's a little bit of a gauge of the temperature of the global economy. So there might be a macro takeaway there as well. So we're encouraged by the copper breakout. We did also have, as you know, a big gold breakout. I think it's probably not actionable at this moment with a short-term pullback underway. But we were excited to see that in part because it was just so long in the making, this huge trading range that had very well-defined resistance. So we're always looking for those kinds of breakouts. In terms of other themes, we always sort of drill into the group level work, and we're always looking for different setups to leverage. But it often comes down to kind of like high beta groups versus low beta groups. We took a ratio of SPHB, which is the high beta ETF for the S&P, versus the low vol one, so SPLV. And that ratio has been trending higher, favoring higher beta areas of the market. And so that's a strong tape typically, right? So we have been sort of generally favoring these higher beta areas, but it does show a loss of momentum that would suggest that we have a little bit of a turn for that would favor the defensive sectors, more value-oriented names, things of that nature, like the financials as one.
So, Katie, I was looking at your website, and I wanted to highlight that there's an April summit, a women's summit that you're involved with. Talk to us a little bit about that upcoming summit, if you would. And frankly, then afterwards, if you're good with this, talk a little bit about being a woman in finance.
Yeah, of course, and I'm happy to. So it's an advisor hub event in New York City, and I'll be joining as a guest speaker for that event. I went last year, and it was fantastic, and a great way to network with peers and with advisors. And I love, I guess, taking part in that type of thing. I found that, since I went from really Wall Street to an independent research provider, right? I've noticed that less of my time is spent visiting clients. I used to go to Boston and have a full day of meetings visiting clients. Because of Zoom and COVID and also being independent, I do less of that, but I do more conferences. And, it's a great way to stay in touch with people. And with our ETF that we launched, that's been a whole new world for me. So it's been a great way to educate myself on that industry, which is really a subculture of its own. And so the women part of it, so the women, there's also a women in ETFs group as well. And I say group, it's much bigger than just a group. It's a massive organization. And they just had their 10-year anniversary in New York City last week. So that was a really cool event, and made me appreciate being a woman in ETFs, but also being a woman in our business, being technical analysis and then also finance. There's been a lot of women who have come before me who inspired me, like Louise Yamato would be the first person that comes to mind. She was a great technical analyst and really still is. She's still looking at the charts. And she inspired me. She was in what was definitely a man's world in the way that I really wasn't, I feel like. It wasn't quite as pronounced, I think, when I started my career in the late 90s. But progress, right? It's been a lot of progress for women. I feel like as a woman, I've been supported in a way, which is really nice. And my hope also is that it inspires more young women to get into fields that might have before deterred them. Just, they shouldn't watch The Wolf of Wall Street as much as it's a great movie. That might scare some people off, right? But, to me, it's always been a positive, and I'm proud of it. And I try to do talks at universities and things like that to, help inspire younger people to go into fields that maybe are more sort of STEM oriented. There's obviously a big push towards that.
We have a...
So David, how have you structured your firm as well in that context? I think it's a woman-owned or...
Mm-hmm. Yes, so there's actually a national sort of recognition of women-owned firms. So it's a WBENC is the acronym, and then women-owned small businesses are also recognized. So we're recognized as both of those. And trust me, it's not as simple as just saying, "Hey, I'm a woman. I'm a founder." There's an actual, real, long-term process that you have to go through to get that recognition. So we're proud of that. And when I received my CMT designation, or Chartered Market Technician, I was the youngest woman at the time who had received it. That was in 2001. So it's just really remarkable how far our discipline has come. And I would probably extend that more broadly, where I would go to a conference and it was just so, male dominated. But now there's a lot of women, and it's really great to see. And especially now in the ETF side of things, I'd say there's even more women. So it's really nice to see and have peers, who have gone through similar things as I have.
And my last question on this issue, it's rather important in that my vision of women as investors is that it's going to be a natural progression where women are going to inherit more money, right, and have greater control. How do you see women investing versus men? Because we're different, right? I think that's the honest truth.
Yeah, I would agree with that. And it's funny because without it being intentional, I feel like the ETF strategy that TACK is all about is really quite conservative. It's designed to manage risk, and I'm as a woman, perhaps I'm quite risk averse. So, and I think that a lot of women share that with me. I can't make a blanket statement without really knowing. I haven't polled, my female friends, but it's just something that probably is more natural to us. And I think it's a great way to balance out sort of a risk-taking appetite, perhaps, right? So we do approach, I approach my business conservatively, and I approach investing conservatively. I really believe in long-term investing as much as I focus at times short-term. So I think my ETF, is a manifestation in a way of my, sort of perspective on the markets and what have you. So I definitely think you see that influence in portfolio management. And I think that, firms are right to value it and are right to consider diversity as important. And somebody, I can't remember exactly what the quote was, but at the Women in ETFs event, somebody said something about diversity and diversification as both being very important. And I certainly agree with that.
Very well said. We have a question from one of our favorites in our crowd, from Eric Connerly, asking how the spread of visual-enabled AIs have affected the dynamics of humans' interpretation of technical patterns. Are the turns turning quicker?
I like that question. The turns, I would say, probably are in some asset classes. And I would actually pile into that. Maybe it's not necessarily all about AI, but it could also just be ETFs, right? Any product that sort of can exacerbate a move creates quicker turns, I think. So it's a market structure thing, probably as much as it is an information flow type of thing that's driving that. But I think we're all very lucky to have so much information at our disposal, and the access that we have so quickly to the information is something, of course, that wasn't the case when I got into the business. So I'm really grateful for all the tools that we have, the technology that we have. And, I feel like for technicians, it's a huge benefit because we just have so much more capacity, right? And with that capacity, we can see more opportunity. I can scroll through hundreds of charts in a day, and that's certainly something I couldn't have done a long time ago. So we have a great capacity with this, technology, and we haven't done much to integrate AI into our own business, but I see the potential in so many ways, and it certainly applies to what we're doing. It applies to markets, and if anything, I just think it's opportunity.
So there's a follow-up question from somebody in our audience. And they write, and it's E.L. Larson who wrote it. It seems you traded out of GLD in TACK just when momentum increased. Can you comment a little on why?
We actually still held it was GLDM, so that's the mini shares. We swapped GLD for GLDM because of the expenses. We wanted to pass through the lower expenses on the mini shares. And we held it until just this past month. And so we captured some of the gold momentum, I would say. But we're not evaluating the gold mini shares or the other risk off categories for the same momentum and relative characteristics that we are the sector. So we're not treating them as the same in the model. We're treating them as something to default to in a weaker environment. So there are global macro funds that would certainly consider it to be more of like a momentum play or what have you, but we're seeing it as a lower risk asset class and a weaker tape. So we don't want to be exposed to gold with the potential for it to underperform in a strong tape. So we feel like the timing actually was pretty good just by default. I mean, we're glad, it wasn't our own market timing, but we're glad by the way it kind of played out and left the portfolio at a time where it had, essentially broken out and was ready to pull back.
And by the way, good for you for owning the lower cost one as opposed to overpaying for the same exposure.
Yeah. And it's with the fund of funds like we have, we're carrying the expenses and then passing them through. So our management fee is 59 bips. And then we have essentially a pass-through. So in any way that we can reduce the expenses overall. So we've already, changed into another fund, but also the components, the underlying sector spider funds, or actually the underlying treasury funds have gone down in price since we initiated, which is great too.
Yeah, I think it really all comes down to the benchmark. If you were benchmarking against a more absolute return style portfolio, you might have gold in on its own merits, but as a strategy, looking to outperform equity benchmarks, you're going to tend towards equities. And it seems like these defensive assets are in replacement of enough breadth in the aggressive side of the portfolio.
That's
so
reason.
Is that fair?
It is fair. And the technical benchmark for the TACK ETF is something closer to a 60-40 type of index or model. It's called the Morningstar Moderate Target Risk Index, which we've outperformed since inception and this year by a nice measure. And where we hope to, outperform the S&P 500, of course, is over the long term by reducing those drawdowns. So not only do we want to, capture the sector momentum and relative strength, but really the huge added value is in avoiding those massive drawdowns by trying to, better than have them in terms of the portfolio through those other asset classes.
Katie, we launched funds at Title Financial Group. So I asked this question in a self-serving way, so forgive me. Do you have any thoughts about expanding your product lineup in ETF world and launching a global fund?
Like I said, I'm real conservative in how I run my business. So it's definitely a thought. But, we've always wanted to make sure that we, got TACK to a very good place and, a foundational product. And we do have hopes to launch another product that would be a nice complement to it. I think there's a lot of potential to take the model that we have and apply it over different time horizons and to different asset classes. So stay tuned.
Awesome. So, we're at the top of the hour. I put some links in the chat. A lot of people are listening on Twitter, of course. David, do you have any more questions or thoughts?
No, I mean, unless there's in general like some asset classes that you think we missed that we haven't covered. I think we kind of went through a little bit of everything from international equities to small caps to U.S. sectors to gold, Bitcoin, VIX, treasuries. So by all means, if there's anything you think we left out here, Katie, that you think it's relevant to your current market perspective, please jump in and cut us off. And
yeah, I mean, I would just say that, treasury yields, right, which, should be on everyone's radar, of course, that what we identified, a couple of years ago was a secular shift, right? Now we all are pretty comfortable that that's happened. The 10-year yields reversed this secular downtrend channel that had been in place for decades. But with the strong uptrend that we've had in yields, just over the past few months, we've seen a real loss of long-term upside momentum. So we actually are in the camp that this year and potentially part of next year will be a corrective year for yields, meaning that they're maybe sideways to lower, could dip below 4% into the mid-threes perhaps. And that is something that can foster a stronger tape, even though it's already been very strong. So we're bullish in part because of the breadth, because of the breakouts that we've seen, and because the environment is favorable from that sort of macro technical perspective.
Well, awesome. Katie, thank you very much for joining us today. And
of course,
we will see you at conferences.
Really a pleasure. Thank you very much.
Same here, guys. Take care.
Bye-bye.
Bye.